Are your competitors 100% full? If they're 60, 70% occupied and you're buying a facility that's 60 or 70% occupied, don't buy there. You get to choose in this scorecard. We get to score that area. We get to score the deal and say, is this worth it? Especially compared to all of the other deals we're looking at.
From cornfields to high-rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
I've got Guy Varble here on the show. Guy, welcome.
Thank you for having me today.
I'm excited to be here. Hey, say for the audience to say, who are you? Where are you from? What do you do?
Guy Varble, live in Urbandale, Iowa. We do self-storage facilities in pretty much anywhere in the country.
Self-storage. How in the world did you get into self-storage?
Well, we thought we would be interested in it for a long time. In 2017, we really started doing some research. In 2018, bought our first facility and really got into it and said, we're out of everything else. So we started selling all our other assets and actually just sold our last personal single-family unit. So we're now officially have no personal
residence. Yeah. So you had a portfolio and a bunch of other things. And then when this was it, you decided to go all in.
Yep.
Reminds me of Rockefeller. I read a story. In fact, I actually listened to a podcast, Founders, one of my favorite podcasts. Listened to that on Rockefeller. When he decided to go into steel, he pretty much abandoned everything else, including the stocks that he owned, because he didn't want it to distract him on a daily basis when he would get his newspaper and have to go look at his stocks, because he thought that there was too much of a mind distraction.
I could see that. Well, and part of the reason was when we finally understood the value, the impact of the ability to force valuation in self-storage versus the residential side of the business. We used to flip a lot of houses, made some good money flipping houses, made some good money owning rentals, not so much on the cash flow, but on the appreciation over time.
Yes.
Right. The depreciation on that kind of stuff, that was really good for us. But when we got into self-storage, it kind of moved the decimal point over one. Everything moved slower. The numbers were bigger.
Yep.
And you're able to accumulate a larger number of units. And so we'll just use this number, for example. If you have 4,000 units and you bump rents by $15, people typically just won't move out, right? But that will influence the value by about 12 million. So the value of that asset will go about 12 million. So the question is how many times can you do that over the next decade? I don't know what your number is, but that's a pretty big number to me.
Yep.
So when I started to really understand that you could really impact value on a self-storage facility, like you can with multifamily, for sure. If you've got a significant number of units and you can bump rents by $150, I mean, that's the same kind of concept. Turns out, though, that inflation is our friend in self-storage. And so it allows us to be able to grow that. And then the other thing I really learned was if things go really bad in the economy and people start losing their houses right and left, we don't celebrate that. We aren't happy with that. We just realize that self-storage goes to 100% occupancy. So it's more of a recession-resistant kind of product. And then if people are making money hand over fist, which we love in the economy, then we go to 100% occupancy because they have a C2 in one unit and a snowmobile in the other. That's just how that works out. And so that recession resilience, that ability to sort of impact and force appreciation over time, the fact that tenants are typically sticky. A couple of the main portions of tenants are really sticky. And so they're not super price sensitive. I mean, everybody's price sensitive, but they're not super price sensitive. And we have no tenants and landlord-tenant liability issues, right? That's a really...
Yeah, they don't pay. It's easy to get rid of their stuff. Not them, because they're not there. Their stuff.
That's the value. So all of those combined. And as I looked at all of that, and I looked at all of the headaches we had in the company and all of the stressors that the employees were having and everything they were looking at, we decided, let's just sell our multifamily, single-family units and focus in on this.
And that's what you've done ever since.
Yep.
You do it not just in Iowa, you do it through the Midwest, and it sounds like, through across the country, and largely because you've identified some of the drivers that, what it takes to identify a good market. And then inside of there, it's how does your property situated in the marketplace?
Right.
Talk to me about some of the key factors that drive both the geographic area, so the city, let's call it, and then more down at a granular level, this particular property on this particular block.
Sure. So Self-storage is very localized.
Right.
So people will drive 45 minutes to 2 hours every day to their job. They want to be within 5 minutes of their self-storage facility. It's almost like a gym. They don't want to drive across the city to go to a gym. They just want to be close to it. It's kind of that concept. I don't understand all of the socio reasons that people do that, but that's kind of the function there. And so it's a very localized area. We look at 3 miles and 5 mile areas. And if it's uber dense, like 200,000 people in a 3 mile radius, really, really dense, then we might go down even to 1 mile radius. So it's very, very localized is what we talk about on self-storage. So if this 5 mile radius doesn't work, we'll go down the road 10 miles, see if that 5 mile radius works. And we'll go inland 5 miles, right? So you have these 5 mile spots. Biggest factor we look for, change in population. Change in jobs, change in population. We want to see increasing jobs, increasing population. So some areas of the country might be losing people due to taxes, due to state government, due to whatever reasons. And they're moving to other states and other areas because jobs are there. Typically, it's sales tax, property tax, income tax, like all of those things sort of make for a better environment for that person. And with COVID, we saw a lot of people able to realize that you could work remotely. So you could now work pretty much anywhere in the country. You could live there and work at your old job. That whole mindset has really opened up people transitioning across the country. We underwrite maybe, 10, 15 deals a week. And so we're looking at that 5 mile radius and we look at job change, we look at population change. And if we're losing people and we're losing jobs, I don't care if it's a great deal. I'm just not interested. I'll go find something somewhere else.
All right. And you're identifying an asset. Is there a certain size threshold that it must be in order for you to go, yeah, we've got some minimum standards here or maximums perhaps?
Yeah, there's no maximum standard. So it depends on whether I'm buying it with my own cash, my own stuff, if I'm syndicating the deal with other investors, whether or not I'm giving some sort of returns over a 3-year period, 5-year period. Each of those factors will come into play. Let's just start at the premier product. This is a product that's going to be 80 to 100,000 net rentable square feet. We're going to build it ground up. It's going to be the 800-pound gorilla in the market. We're going to control pricing and from the sense of we're going to be able to dictate, here's what we think the market should be, and we'll be able to drive that. It doesn't mean we have like a monopoly or anything like that, but when you have size and quality and newness to an industry in an area, you really can impact value because you get to choose where you're going to be. Right. You aren't stuck there. So that upper limit, that's what the REITs want to buy. They want to buy these bigger facilities. Now, there used to be no upper limit, and there are some upper limits now for the REITs. They don't want to buy these sort of really huge facilities. And so we kind of look at that minimum 65,000 to 115,000 square feet. That's about the size we want to be if we're looking for a real estate investment trust to go ahead and buy us either at certificate of occupancy or stabilization or that. And the reason we want them to do that is they've got a lot of cash on their balance sheet. And they got to move that cash. Otherwise, it burns a hole in their pocket. So if they buy an asset that's appreciating in value and generating cash flow, that's super valuable for them. And they're willing to pay for that on a discounted cash flow model basis. And so that's what's good for them. And then as we start to step down into projects, why are we buying it? Are we going to buy it to keep it forever? Are we going to buy it to turn around and sell it? Are we going to buy it for just a small interim piece of time? Do we have investors that are looking for cost segregation or some sort of deferred aspects? Like there's an important aspect that comes to that. This 25 to 30,000 number is a pretty interesting size, right? Because it's going to put you at this 250, 300 unit size, and that's going to impact whether or not you can have a facility manager on site. As you know, facility manager is expensive, right? And I'll just tell you that if people don't answer the phone, you don't get the customer.
That's right.
They just move on to somebody else, right? That's the issue. So you need to have somebody who's got the ability to answer the phone, represent you well, and basically close on the deal as the customers are coming in and help them get what they want. I will take a Class A facility manager in a Class B facility any day over a Class B facility manager in a Class A facility. Personal touch is very, very important. So what ends up happening is if you get in these smaller units, you might lose a little bit of that personal touch. It's going to be more of a call center. It's going to be more phone. You don't have a lot of this face-to-face time going on. So that becomes more of an issue. And if I'm buying a facility that is maybe in 20,000s, people in a 5 mile radius, and it's got a couple hundred units, I'm going to want to make sure that where I fit in that market relative to all of the other competitors. If all of the other competitors are about like that, then I'm in the mix.
Yep.
But if I'm at the bottom, meaning I'm gravel and everyone else is paved, or I've got old doors and everybody's got brand new doors, or I've got a bad paint job and everybody's that, or they're all gated and I'm not gated. Like if I'm at the bottom of the list and there's really nowhere for me to move, then it's probably not a great opportunity. But if I'm in the mix and we're have the ability to go ahead and increase safety and security, which are the two main things that tenants are looking for. And that comes through lights and gates and cameras and that kind of stuff. Then we would look at the smaller and lower units, right? We could look at that because you're able to secure the facility. People feel comfortable going there at night. They've got lights, they've got cameras. They feel like they're protected. They have ease of use of the gates and the doors and all that kind of stuff. We'll look at some smaller units. I will say that when you get below that 100 unit mark, you probably need to be living there. You need to live in that area. You need to manage yourself. And that's fine for some people, but that's not fine for a doctor or a dentist or chiropractor or an IT exec or whatever. They've got a real job doing what they're really great at. They don't have time to be answering the phone for a $45 a month unit.
It's fair to say, or would you agree it's fair to say that it's not only just real estate, it's a consumer-facing business?
Oh, absolutely. And I tell everybody this. I say, it's like, I know I use Subway. I've never owned a Subway, but you need to have a marketing plan. You need people to come through the door.
Yes.
You need to have, things clean. Can't have sticky floors, right? It's a customer-facing business. Customer reviews are a big deal. People find you on their phone. They check your Google reviews. They check your Yelp. They check these other things, right? It's a big deal. And if you're not responding to dissatisfied customers, both, logistically, you have to respond to them. If they're dissatisfied with your facility, you need to fix whatever the issues are. But if you're not also responding to them in the social media market, then you're really doing a disservice to yourself. So it truly is a customer facing business. You really do need to be aware that real estate is where it sits, but the real value is in the net operating income, the cash flow. And cash flow is directly impacted by customer satisfaction.
Directly impacted by customer satisfaction, and that largely impacts the occupancy of the units of the project. Historically, the number one threat to self-storage facility was another self-storage facility, meaning you just literally go one block away and build a new one, and all of a sudden you now have 50 or 80 or 100,000 square feet. There's direct competition down the street geographically. When you're looking at a deal, how do you give thought to that, or do you, as part of your due diligence process, to go, is this something we want to bite off on?
We want to be the one who's building that 80. That's what we want to do. So when we go and look at a facility and we look at an area and I think, okay, am I already competing against 2 extra spaces, a Cube Smart, a public storage, all in a 5-mile radius? What else am I going to add that they already don't have in brand recognition and all that kind of stuff? I don't know if anybody knows this, but a lot of times those buildings are not owned by those companies. They're just marketed. They're just managed by them. And they're owned by companies like us who build them and have an investor group that invests in them. And then we just keep them over time. So that's a big deal. It's a very big deal. So when we go and we look at the analytics of an area, we say not only what's happening in that area from job growth and population growth, but what's happening in that city. Do we see a westward movement and we're on the far east side where all the newer houses is getting built out there, all the multifamily is getting built out over there, and we're on the edge of the stretch in the wrong direction? That's a big deal because eventually you're going to get a big player out on that side of the city. So if we're buying an existing facility, we want to kind of be in the path of growth. We want to be really close as we can to multifamily. It's a very symbiotic relationship with multifamily and self-storage. We want to be there. We look at what's called storage index number, or the supply of square footage per population, So per capita in an area. National average is about 8.5 right now.
8.5. You're largely talking about the square feet available per person within a 135 mile ring.
And in the country, it's about 8.5. So all the square footage in the country, all the people in the country, that's about the number. That's a supply number. That doesn't tell you if demand is great or not. Just tells you if supply is good or not. So demand is the other function. That's the main function of that. So are your competitors 100% full? Do they have a wait list? You got to know that. And so if they're 60, 70% occupied and you're buying a facility that's 60 or 70% occupied and there's 2 deals in the pipeline that are going to be built, don't buy there. That's the great thing is you don't have to buy there.
Right.
You get to choose in this scorecard, right? Like I talked about. Like we get to score that area. We get to score the deal. We get to score the community. We get to score all of that kind of stuff and say, is this worth it? Especially compared to all of the other deals we're looking at.
Yeah. Just because I see this a lot and a lot of people talk about this. Hey, this thing's 30 or 40% vacant. We've got tremendous upside opportunity.
Right.
Maybe.
Yeah, maybe not.
Maybe not. Maybe everybody's overbuilt in the area and your 40% vacancy is good as it's ever going to get.
Well, and that's one of the things that we check for. Like, okay, if you're at 30 or 40% vacancy, what's your website look like?
Right.
What's your Google AdWords spend look like? Are you working with some of the aggregators out there that aggregate and then sell space? Like, what are you doing? What's your relationship with the local apartment managers? What's your relationship with the elderly folks' homes that you get some transition that is happening in there? Like, what's your, what we call sort of grassroots marketing efforts happening? And we'll find, like we're looking at a facility right now, they inherited it from their dad who owned it for 25 years. They've had it a couple of years and drove it into the ground. So I look at that. I'm like, okay, you have no website. You've got no, you don't answer the phone.
Right.
Well, okay. Now I know we can add value simply by putting up a website, actually taking credit cards. There's people who don't take credit cards. Like if you tell me I don't have a website, I don't take credit cards and I want to be 100% occupied all the time, I'm like, sign me up. I'll pay you whatever you want because I know it's probably worth twice as much as you're going to get.
Hey, Iowa investors, this is Ava Baukamp, Chief of Staff at Legacy Impact Investors. Have you thought about adding real estate to your portfolio but don't have the time or desire to play landlord? At Legacy Impact Investors, we do the heavy lifting. Our team finds the deals, manages the properties, and handles all the day-to-day operations. Our select group of qualified investors co-invest with us, gaining ownership equity without opening a tenant email or responding to a maintenance call. They just share in the income, appreciation, and tax benefits. These opportunities aren't for everyone. They are for qualified, accredited investors only. If you want to learn more, please visit legacyimpactinvestors.com to apply.
There's a couple of asset classes out there in this country where it was predominantly owned and operated by mom and pops.
Mm-hmm.
You know, self-storage comes to mind, mobile home parks come to mind. There's a couple other things, you know, the small end of the apartments come to mind. And there's tremendous consolidation taking place over a period of time, certainly in the self-storage facility area, given certain sizes.
Right.
You got to have some size, you got to have some mass because all the REITs that are out there, they want to roll this stuff up. Like you said, they've got money in their pocket burning a hole. One of the things I read some time ago was that the president of U-Haul said, when we buy a facility, we don't have to make money for 5 years.
That's right.
But when I read that, that is a scary proposition that you're going to go to battle with somebody like that.
Right.
How do you interpret that? And then I guess, how do you give thought to that when you're looking at a deal relative to where they are in the marketplace?
That was probably Joe. This is the one thing. If you go to Self-Storage Association conferences, you got to meet these guys.
Yeah.
Have a drink with them, have a dinner with them, a meal or whatever. I mean, you know, they're regular people.
Correct.
Right. And they just have a job to do. And their job is different than my job. Yeah. Right. And they're looking for good quality assets. As a matter of fact, I bought a property that U-Haul backed out of, and it's going to be a great deal for us. It's been a great deal so far, and we're going to build another 80,000 square foot on it, and eventually maybe we'll sell it back to them. I mean, it's because of that kind of concept. So, I mean, U-Haul's interest is interesting because I think it's been a number of months since I looked at their balance sheet, but I think they've got $2.4 billion of cash and cash equivalents on their balance sheet. That means they got to move money.
Yep.
That's a big deal as opposed to some of these other REITs that maybe have less cash.
Correct.
So here's the thing. If I'm going to buy a piece of land and I'm going to build on it, it's going to take a year. I buy it, and that's assuming that I'm ready to build at day one.
Yep.
If I've got to go through the entitlement process, that could be another 6 months, 18 months. Right. So I buy the piece of land, going to go ahead and build it. And then I've got some other thresholds. I'm like, what's my occupancy requirement to break even on operations? Not including interest, just operations. I want to know what that is. And then what's my next threshold, which is debt service coverage of 1.0, right? So like the facility now is covering all of the payroll, all of the expenses, and it's covering all of the interest payments to the bank, right? Whether it's principal and interest or interest only, there's that. And then we get to the debt service requirements of the bank, which is typically 1.25, right? So these are three thresholds that we look at. And then we look at stabilization, which is that 85 to 93% occupancy, right? So we look at those numbers. So the question is, and I don't know about U-Haul's approach, but if they're buying land that's not entitled, right? That's just land banking. All you're doing is you're buying land, you're land banking it. And I don't have that ability to just throw money at land and wait for the city to grow into me.
Right.
I don't have that. I'm just not that big of a guy.
Yeah.
So if they're including the entitlement process, that totally makes sense. But if they're paying 100% cash, then they really only need to get about 35% occupancy, and then hit their break even on operation.
Yep.
So depending on their debt structure, and these bigger REITs, they got some really great debt structures.
Correct.
If you go and look at their reports, they tell you when their debt's changing and stuff like that. And they got much lower debt than I do. I mean, the reality is if they've got that ability to wait, that's fine. What they do have is they've got shareholder responsibility.
Yes.
They've got to get some sort of cash flow, some sort of return, some sort of growth in equity. And some of the other bigger REITs really are focused mainly on growing their management aspect of their business. So if you go and you look at their stated requirements, they have a certain number of facilities that they're supposed to grow into by management. Some of them are supposed to grow into by building or buying. Some of them are supposed to grow into in maybe different areas. So they have different numbers that we need to look at. Where that benefits us is when we go and build a facility that they need to buy or manage, it's a pretty big deal.
Yeah.
Right. Then that meets their needs, which is not the same as our needs. So that's how we interpret that. Right? They don't need to make money for 5 years. That's because they have other needs they need to meet. And profitability on that specific facility may not be the most important aspect, where it is for me. So we're not really competing necessarily on the same thing.
Publicly traded companies have many different levers, don't they?
They do.
And responsibilities. What are you most excited about this year?
Well, I mean, on a personal level, my kids are doing well and my wife's doing well and all that's great. So, I mean, we have a saying, which is, we do business to live, not live to do business.
Yeah.
And so I think that's the deal. It's an interesting time. We've got a lot of volatility right now with interest rates being so high relative to what they were 2 years ago, 3 years ago. That's an interesting issue. It's caused a lot of players to sort of pull back a little bit that are dependent on debt. That's allowed for a lot of sort of shovel-ready deals to come on the market. We're actively looking at different debt products all the time. We actively are looking for investors all the time. Yeah. One thing I don't think I've told you yet. So we used to syndicate deals one at a time.
Yep.
We've created an equity fund. And the equity fund allows us to structure, it's more of a customizable fund, 1 ppm, and allows us to put equity, debt, preferred equity, bridge, hard money, like whatever we wanted to. We could create those types of deals and then flow them out into the market, right? And so that allows us to do is bring in investors and have them choose which deals they want to be in.
Yeah.
As opposed to being everything clumped into all of these. And some people,
singular.
Yeah. Some people may say, hey, this is that. So that's been exciting for us to sort of get into that process. That's been sort of new. I would say I'm hoping that something happens well with the insurance markets. Because the Gulf Coast, all the way into Florida, anywhere where we've got these hurricanes and floods and that kind of stuff like we're having right now, insurance has tripled in the last 14, 15 months. And when you have that tripling of that expense, it's a really big deal.
Correct.
So what that's caused us to do is sort of stop writing in those areas, underwriting in those areas, and push us into other areas of the country. I think the ability to have that flexibility, to know that and understand that, because we underwrite so many per week.
Right.
We are, I feel like, have our pulse on the market. That is neat. It's neat to have that and understand. So we'll look at a deal. We'll say, man, trends are down 20, 30% in the last 12 months in this area. And we'll come across a deal where they're up 12% or 50%. We're like, that's exciting to us when we find those types of opportunities. That's exciting. I feel like that.
How are you navigating debt in today's market?
Yeah. So there's all kinds of things that you need to think about, right? So let's talk about it from like a syndication sort of limited partner, GPLP kind of mindset. You might have to drop your limited partner returns a little bit because you're going to have to drop your debt as a percentage of the overall capital stack. Yep. So what ends up happening is you may say, look, I'm going to give my limited partners 15% IRR or 18% IRR, or 20, whatever it is, right? And then you might have to say, okay, well, we're only going to do 55% debt or 60% debt. And then we're going to bring in a bridge or pref or mezzanine or something like that. And then we're going to bring in our common equity commit groups. So that's the concept. I'm talking to a group right now. They're doing about 90%. They'll do 90% on construction. And so, yeah, they're going to be 8.5%, they're going to be 9.5%, 10.5%. But if I'm paying 18% IRR to my investors at 35 to 65 and debt's at 8.5, right? Weighted average cost of capital is 12 or 13.
Yep.
I mean, the numbers will still work out okay for us.
Yeah.
We have to be very careful. Like the biggest thing for me is making sure that we protect our investors. Like above all things, people give us money and they don't give us money. They give us their future. It's their retirement, kids' college fund. It's their travel plans. It's the money they need to take care of their parents when they get older. You can't screw that up, right? Like you just can't. And so we want to make sure we structure deals that are properly structured so that if something goes wrong in the deal, the investors are covered. And if it goes really wrong, then we've got the ability on our side to give away some of the general partnership equity so that we can make the limited partners whole, or at least, brought up to a point. We've never been in a position where we've lost anybody's money that way or that kind of stuff. So I don't know what that would look like, but we are what I would call risk managers. Like it's my job to de-risk the entire project. And we look at risk all across the spectrum, and debt is one portion of that risk.
Right.
And the ability to refinance. I mean, what happens in the ability to refinance? I don't know anybody who goes, oh yeah, I think interest rates are going up. Right. I mean, you look at all of the Fed chairs and you look at the averages of all that kind of stuff. There's a couple of them that are a little bit outliers.
Correct.
But at the end of the day, you have to say, okay, I'm going to structure this deal, and you can't be Pollyanna-ish, right? You have to be pragmatic.
Yes.
And you have to be able to say, well, what happens if these things happen? Is the deal still worth it? Right? Is that risk adjusted return I'm going to give to my investors? Does that make sense? Do I have a ability to sort of backfill into that if I need to? Can I give up equity on my side? Yeah. I'm in one deal right now where we are 10% owners and 90% is the LP, and I won't do that again because that's just, I don't have anything to give up. Right. If the deal doesn't work out as strong as I wanted it to, I don't have anything to give. Yeah. Right. But if I've got a different structure, then I've got more to give, and I like the flexibility.
If you're a house flipper, execute the burst strategy or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
Where does that thought process relative to risk mitigation, relative to understanding the debt, the capital stack, the stress testing, ultimately is what I'm saying, of the deals, where does that come from?
Well, I think it comes from a lot of different parts of my life. So some of it's education, some of it's practicality. So my undergraduate degree is in economic and business. I've got a master's in business administration. I worked for Procter & Gamble, a huge company, and they did a lot of that kind of stuff. I was a banker, commercial lender. So that's another aspect of things, like when we would lend money. I mean, what I learned early on is that a banker's job is to not get fired. It's not to not lose money, right? You know what I mean? It's to not get fired, right? And,
well, how do you not get fired from a bank?
You need to do all of the things you're supposed to do.
Yeah.
And sometimes that includes not lending money. I checked off all the boxes, and all the boxes were yes, except for one no, so I can't lend the money. So as long as they stay within that framework, then they're kind of okay.
Yeah.
And so I look for bankers who actually have a real practical sense of they need to move money. The real need of a bank is to move money.
Correct.
And they have to move it, and they need to get fees for what they're doing. So they got to move it, and then they need to get an interest rate spread. And then they're probably going to swap it out with a credit default swap or something like that.
Then they need to get their actual money back.
Then they eventually need to get back. But if they do it, then they need to get it back. And so I would say this. I think that my sort of risk averse management process came really heavily in my MBA program as a banker, right? Because you really got to look at things and say, well, how is this going to go wrong? You got to look at the industry. And we liked to lend to, we were asset-based lenders, right? So we would lend to companies that made widgets and stuff like that. So, you had to really understand the industry. You had to really think through all that kind of stuff. And you had to sort of practically look at whether or not this was going to be not only a good deal because the operators were good, but the personal financials and all that other kind of stuff, but that the industry or sector was also good. When I was a banker in California and we had some longshoremen strikes, there were like a lot of ships sitting outside of Long Bay.
Yes.
With all kinds of product on it, some of which we had lent on.
Yeah.
So our borrowers were like, I can't pay you. because it's sitting right over there.
Yeah.
I mean, it's on the water. I can't get it to sell it.
Yeah.
Right. And so that was an interesting product. I think the other part is that when you, as a banker, and you start to learn how to sort of spread financials and sort of look at all of those types of things, you start to think about what's the cash flow process on this loan? Where's this coming from?
Yep.
And so bankers say, listen, I need a primary source of repayment, secondary source of repayment, primary source of collateral, secondary source of collateral, and I need experience. Like those are the 5 things that I need. So primary source of collateral and self-storage is the facility itself. Yep. Secondary source of collateral are the loan guarantors. Yep. Primary source of cash flow is the deal. Secondary source of cash flow are the W-2 from the loan guarantors or something like that. And then the experience is the operators. Yep. When you get into non-recourse debt, it's only primary and primary.
That's it.
There is no secondary aspect of it. And so that deal has to make sense on the face value. Yeah. And so if it doesn't make sense and the bank's not willing to lend on it, then there's probably a reason. I will say this though, not all banks are the same. Not all bankers are the same.
Correct.
Some banks in the area stopped lending money for a little while, right? That's what's going on. And so what you try to do is make sure that you're working with, like we typically would have 3 banks that we would work with. And we want to make sure that each bank, that we made sense to the bank and the bank made sense to us.
That's right.
Right? Because everybody's got changes and you have changes in senior management. They change in processes. I remember when I was flipping houses, I was using said, hey, we're no longer flipping houses. I'm like, I got 3 deals we're supposed to close on. Right. I say, well, we can do one. I'm like, okay. So I was scramble time. So I think that the risk management aspect of things really came into play. And then as I flipped houses and I lost money on a couple of houses that I flipped, that was not good.
Yeah.
Right. And that conversation with my wife, she's like, hey, I'm like, yeah, I know. Would have been better if I just took a vacation and did nothing. Right. For that
Correct.
Payment. Right. So I think when you lose money on deals, it slaps you across the face.
Correct.
Right. I mean, you really have to understand, hey, this isn't just going to work out because you want it to.
Right.
You have to make it work out.
Correct.
And when you're flipping houses, it's almost like adult babysitting. You got to work with the contractors. You got to show up. You got to check mugshots on Monday to make sure they're not in jail or like whatever it was. Like, it just is the way things are. And I think the practicality of going through a lot of those deals and just having them, you look at the ones that went really well and you find out why did they go well.
Right.
Right. Hopefully it was not luck. And you look at the ones that went bad. And if they went bad because of bad luck, if there's such a thing, right? I mean, you have to understand that you personally are responsible.
Yeah.
Even though it was their job to get it done, it was your job to make sure it got done.
That's right.
And so when you take that sort of, I don't know if you read the book, Extreme Ownership.
Yeah.
Yeah. Right. Yep. So it's a great book, right? It talks a lot about what are you going to own and then what systems and processes you get in place to make sure that all of those things are happening. We sort of talked about that managing the manager kind of thing. Well, that comes through maybe a little bit of hammer and anvil kind of thing, flipping houses and that kind of stuff. So I think it's the education, the banking, the practicality of having to rush through it and brumble through it. And you just got to hone yourself into not falling in love with the spreadsheet.
Yes.
There's not a deal. Like sometimes the best deal you do is the one you don't do. Like you got to know not all investors are good investors, not all managers, good managers, not all money is good money. You got to vet all of that. And I think some of that just comes with experience.
Yeah.
Right. I mean, we both have a few years behind us.
Correct. Yes. It comes with experience. Oftentimes now, some of those you can flesh out real quick.
Oh, very, very quickly.
Yeah. No, red flag. Been there, done that. Do not pass go. All right, Guy, you ready for the final 3 questions?
Sure.
If you had one piece of advice for your 20-year-old self, what would it be?
To find something to live for other than yourself. Deeper, right? Like find something, someone, when you dedicate yourself to that, then that's bigger than you. Then you have to stretch. You have to become better, right? When you're only focused on yourself, then you kind of get settled wherever you're at. And maybe you never reach your potential.
2 books that changed your life.
The Bible was one. I would say that's for sure. So, I mean, we'll include that one as an obvious one.
Sure.
I will say Never Split the Difference by Chris Voss. Yeah. It's a book I will recommend to everybody. Business owners, be careful about recommending it to your employees, but it's still a good thing, right? Yeah. Well, I mean, somebody asked the question, which is, what happens if you spend all that money training up your employees and they leave? Mm-hmm. And the answer is, well, what happens if you don't and they stay, right? Yeah. So that was that. And then The One Thing by Gary Keller. That book, it's required reading in the company, Like, what's the one thing you can do by doing that one thing that makes everything else easier? And that's why we ended up selling all of our portfolio.
Yeah. You haven't seen my office. We bypassed it on the way to the studio room here, but the quote is printed and taped above my computer.
Oh, good. And you know that your team really understands it when they mock you. I had somebody say, my one thing today is to get you to do my job. Like, good. You read the book. You understand the theme.
Yes.
Let's go ahead and make it practical. Yeah.
If you were cast away on an island for a year, you could only get 3 pieces of data about your business each and every month to know how your business is running. What 3 things must you know every month?
So, boy, it's going to be top line revenue, right? So this is going to be what we call gross revenue, right? That number, you got to know that changes, right? Gross profit. So let's say net operating income, right? Like that's the number. Do I have the ability to influence any of these things, or is it just information?
No, you're just getting info.
Okay. Without the ability to change it. So I guess the last thing that really, really, really important last thing is just occupancy levels. Like I need to know what occupancy levels are happening on a facility level basis.
For you, why Iowa? You could go anywhere. You could do what you do anywhere. And naturally, you invest in multiple places, including Iowa. But what keeps you here? Why are you here?
Well, we moved here 20 years ago.
Yeah.
Bought a house, 3 houses from her mom and dad and 4 houses from her sister. And we've gotten together every Friday night for 20 years.
Yeah.
And we thought about moving a number of times, but why would we move away from that?
Yeah.
And to where would we move? Well, that's the whole point is family. My kids got to see their grandmother 300 days a year.
Yeah.
We developed a deep and intimate life and relationship with each other. And sure, it's got some winters and heats and that kind of stuff. And it's not, shall we say, I think of Santa Barbara, which is where I went to college and lived there. And it's definitely a different environment than here.
Yes.
But it's really the relationships. It's the relationships with the friends that I built and that. And then you can travel. And we do a lot of travel, but that's what it is.
Yeah. Guy, I've asked you lots of questions. What's one question I did not ask that I should have asked?
Yeah. So I would say that why is self-storage a good opportunity today as opposed to maybe other asset classes? And I sort of touched on it a little bit. It's a recession resilient thing, right? It's a recession resilient asset class so that if things start to go really bad in the economy, then things go well for self-storage. I think the other aspect is that it's a somewhat fast moving product in the sense that we just have typically either metal or block walls. Like, it's like I tell everybody we have a door. It goes up and down. Yeah. And it's got a lock on it. I don't know what else to tell you, but it's a door. It goes up and down, right? Like it's totally different than all of the other aspects.
Correct.
So if you're going to go out and build 80,000 square foot multifamily, this is a multi-year process of getting that done.
Lots of moving pieces.
Right. And that's okay. You have great operators who can do those and get those built.
Yep.
So I think that everybody talks like return on investment. Return on investment is always a good deal. When we start to talk about return on assets, what is the ability to affect the value of that asset year over year over year, right? Relative to the size of that asset. So it's a smaller assets class. The great thing about it being smaller, and it's also the hard thing about it being smaller, is that you don't have a lot of Wall Street money trying to dangle their feet in these waters. Right. I mean, the deals are $13 million. That's not even on par with anything they want to even think about.
Right.
And if they want to move $100 million, they want to move it in a month, not in 3 years.
Right.
And so like, it's that kind of concept. So I think the return on assets, the fact that it's recession resilient, recession resistant kind of product, it's an asset class that built right, managed right, and in the right location will continue to give great returns over time.
We talked about it very early on, the forced appreciation. In the housing world, single family rentals or flips, the only ability to force appreciation is to go rehab a house and to just reposition it.
Right.
Typically speaking, on a single family rental side, you cannot force appreciation. The only way you actually force appreciation is by kicking the tenant out and selling it to somebody else who's going to occupy it as an ownership.
Right.
So even on a rental basis, there's no ability to move the needle on houses.
No.
It requires getting into the commercial world, and you've done it here and done a masterful job doing this for a long time now.
Right.
For people who want to find you, they want to follow you, they want to connect with you, where can they go? What should they do?
So I would say just point them towards our website, which is momentumwealth.fund, momentumwealth.fund. And then if they want to email me, it's guy@momentumwealth.fund, and you can take it from there. But momentumwealth.fund, that's where you'll see who we are, videos, and then we've got Momentum Wealth Fund on Facebook and we're deploying ads and going to be starting a question and answer series based off of the book, They Ask You Answer. What are the questions that people might ask about self-storage? And we're going to start doing that 15-second to 2-minute sort of snippets.
Yeah.
And just putting that out there so people can have a place to look. So that's where you can find me.
Fantastic. The links are below in the show notes, everybody. Guy, I appreciate you being here.
Thank you very much.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to LegacyImpactInvestors.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.